When it comes to investing, consistency is often the key to long-term success. And while some may think that large lump sum investments are the only way to build wealth, the truth is that even small regular contributions can make a significant impact over time. Now, this is mostly effective because of the power of compounding. The power of compounding is a fundamental principle in investing that can yield significant returns over a long time. And it involves reinvesting the returns generated by an investment, allowing them to generate further returns and accelerate the growth of the initial investment. Now, the combination of consistent investments and reinvested returns leads to the compounding snowball effect. Over time, the compounding effect can significantly enhance the growth of your investments. As the investment balance increases, the returns generated become larger in absolute terms, leading to even greater reinvestment and compounding potential. Now in this video, we're going to go through and see what it would look like if an investor was to just only invest $25 a day into a high quality ETF, something like the Schwab SCHD ETF, over a long period of time. In this case, over 1,565 weeks straight, or just around 35 years. Now the results are going to be shocking, so make sure to stay tuned until the end of this video. Now we're going to go through all that and more today. Right after you, please drop a like on this video and subscribe for more content like this in the future. Now for this video's sake, we are going to use the example of an investor buying $25 of SCHD or the Schwab US Dividend Equity ETF every single day for 30 years straight. Now, the reason we're going to use this ETF as an example is because this ETF not only offers capital appreciation as far as the ETF price, which you can see right here, which basically means that the ETF has historically risen in price, making the original principal investment much higher over time. But on top of that, SCHD also offers a pretty hefty starting dividend yield of somewhere around 3.6%, at least as of the last trailing 12 months. Now, before we get into the math, one of the main components to understand about this scenario, and again the reason why we're using the Schwab US Dividend Equity ETF as an example, is because this ETF in particular has a history of growing their dividend over time, or simply put, the dividend growth of this ETF has been very impressive over the past 10 years or so. Now, what this means in simple terms is that buying into an ETF like this, you are going to get paid raises over time. Consider it no different than a job that you might work at. If you're currently getting paid $10 per hour, but in 5 years you get paid $15 per hour, the current income, the current hourly wage at your job would have a growth rate over time. Now with SCHD, as you can see, investors that bought into this ETF long ago were getting paid anywhere from 12 cents to 20 cents per share per quarter. But as of recent, now investors are getting paid 70 cents per share per quarter, or 64, anywhere within that range. So with the dividend increases over time and this investor reinvesting all the dividends that they're going to get paid over the 1,565 weeks invested, you are going to see the power of compounding really get supercharged. So before we go any further, I think it's important to look a little bit deeper into the SCHD ETF and see how the ETF works and what it has to offer. So SCHD stands for the Schwab US Dividend Equity ETF, and it's an ETF offered by Charles Schwab, which is a financial service company. SCHD is designed to track the performance of the Dow Jones US Dividend 100 Index. The index includes 100 high-quality US companies that have a history of consistently paying dividends and also raising dividends at a very fast rate. Now, the companies within SCHD are chosen based on things like dividend growth history, dividend yield, and overall financial stability. When you invest into SCHD, you are essentially buying shares of an ETF which represents a diversified portfolio of all of these 100 dividend-paying companies. So now heading over here to the Dividend Calculator, this is where all the magic happens. SCHD pays a distribution on a quarterly basis. We're starting off with just $25 as initial principal. We are going to be contributing $9,125 per year, which is $25 per day times 365. So again, in theory, this investor would be spending $25 every single day and investing it into the SCHD ETF. The initial dividend yield for SCHD is around 3.62%. The expected annual dividend amount increase for SCHD, depending on what time frame you look at, can be anywhere around 7 to 12 to 14%. So for this example specifically, we're going to give it a 9% expected annual dividend amount increase. The expected annual share price appreciation around 3%, and the amount of years invested, 1,565 weeks, or 30 years invested. Let's see what we get. So here we have it, guys. Your number one, this investor would have just $25 invested into SCHD, earning an annual dividend of around 92 cents in total. But your number two, after investing $25 per day, remember every single day, this investor would have $9,151 invested into SCHD and already around $355 in annual dividends. Your number two, $18,853 invested into this ETF with over $770 in annual dividends. Skipping down to year number five, already $40,000 portfolio built from again an initial $25 investment and just $25 every single day ongoingly. $40,000 and $1,800 plus in annual dividends. By year number 10, 10 years in, just $25 a day, remember, $110,000 worth of SCHD and over $6,800 in annual dividends. Now, what's significant and what I want you to pay attention to as we get further and further down on this list, year after year, the power of compounding is really kicking in, which simply put means that because this investor is reinvesting everything, and on top of that, adding more principal on a daily basis, the numbers are going to get faster and they are going to compound at a quicker and quicker rate. So by year number 15 years in, this investor has a portfolio of almost $225,000 worth of this ETF and over $18,000 a year in dividends. By year number 20, $433,000 of principal and over $47,000 in annual dividends. By year number 25, $881,000 of principal and over $130,000 in annual dividends. And if we were to skip down to the bottom of the list at year number 30 or at week number 1565, this investor would have a $2 million plus portfolio and over $405,000 of annual dividends paid. Another pretty cool representation to look at is this chart right here, this graph, and to see how the compounding effect really works. What I mean by this is that it might seem like it's starting off a little bit slow, because remember, the power of compounding takes a few years to really get rolling. But as year number 15, 16, 17, 18, 19, the chart really starts to curl up. And I would say past year number 20, the numbers are just getting incredibly high. So what this goes to show is that any everyday investor that has $25 to spend on a high quality ETF, something like SCHD, could also become a multimillionaire if they invest correctly, long enough, and allow the power of compounding to really do its thing. But I want to hear from you guys down below. Long term, 30 years from now, what is your annual dividend goal that you're trying to achieve? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks as always for stopping by, guys, and I'll see you in the next one.